Hello and welcome to the Signia market commentary for June. My name is Ammalan Annalingam and I'm the co-head of multi-asset investments here at Signia. It's hard to overstate just how bad markets have been in recent months, and June was no exception to the trend. For global equities, it was the worst month so far this year. A range of asset classes saw declines over the month, with only the US dollar being the major exception. In total return terms, we've seen the biggest H1 decline for the S&P 500 in 60 years. The main reason for these declines is the ramping up of market perceived as recession risks. There are several reasons for this, but predominant amongst them is inflation proving to be far more persistent than consensus once again, thus necessitating a more aggressive pace of rate hikes from central banks than investors were expecting at the start of the quarter. Specific to June, the May inflation number was released and came in at 8.6% year-on-year versus an expected number of 8.3%. Not only was the print higher than expected, but the number represents the highest inflation has been since 1981. The Federal Reserve, in turn, raised interest rates by 0.75% as opposed to the 0.5% that was broadly anticipated prior to the inflation release. To put some index numbers around all of the above, in June the S&P 500 was down 8.3%, the Euro Stoxx 50 down 8.7%, the FTSE 100 down 5.5%, and the MSCI Emerging Market Index down 6.6%. Unsurprisingly, given the inflation release, there was no respite in bonds either, with the broad-based bond index, the Bloomberg Global Aggregate, down 1.5%. Even commodities had a poor month, with the broad-based commodity index down 10.9%. Within commodities, even gold, usually perceived as a flight-to-safety asset, was down almost 2%, although this could partially be explained by the strong US dollar. The broad-based US dollar index, the DXY, rallied 2.9%. Trying to find some glimmers of hope in the carnage were China and Hong Kong, with the Shanghai Comp up 7.5% and the Hang Seng up 3% over June. These regions were supported by improving economic data as COVID restrictions have been eased, although subsequent rhetoric from authorities in Beijing suggests they are committed to a zero-COVID strategy, leaving open risks of intermittent lockdowns to quash sporadic cases. This strategy differs from most of the rest of the world, which have gone down a path of coexistence or mitigation through mass vaccinations and boosters. That's it for this month, and thanks for listening.